Welcome to another deep dive. I'm absolutely pumped about today's explainer, because we're tackling what is literally one of the most fascinating financial mysteries out there right now. We're going to decode the sheer madness behind PRAX, and I promise you, we're doing it with no confusing Wall Street jargon. If you're fascinated by how the market actually works and how it sometimes completely defies all logic, you are definitely in the right place. We're going to use the raw data to tell a wild story of extreme market psychology. Let's get right into it.
$8.955 billion. Just let that sink in for a second. That is the current market cap of PRAX. To put that into perspective, bordering on a $9 billion valuation means we're not talking about some tiny under-the-radar side project here. No way. This is a massive financial entity. The market has planted this gigantic flag in the ground saying that this company holds immense value. So the financial stakes are incredibly high right out of the gate.
But how did they get to that $9 billion mark? Well, the momentum is what's truly insane. A 1,963.59% return over a 3-year period. I mean, in the investing world, a 20% annual return is usually considered phenomenal, right? So almost 2,000% over 3 years? That is just jaw-dropping. It paints this incredibly vivid picture of massive market hype and relentless momentum.
Now, let's walk through how this momentum actually built up, because this absolutely wasn't just a straight line to the top. It is the literal definition of a roller coaster trajectory. Back in 2021, the stock was down over 64%. In 2022, it cratered even further, down almost 88%. Even in 2023, we're looking at a drop of nearly 38%. Honestly, if you were looking at it back then, you probably would have written it off completely. But then comes the massive turnaround. 2024 hits with a positive 245% return, followed by an explosive 282% in 2025, and that positive momentum is carrying right into 2026. This stock basically came back from the absolute brink to generate that astronomical 3-year run.
Section 1. Where is the revenue? Opening the books on PRAX. Okay, let's dive into this and actually pull back the curtain on the company's fundamental reality. Consider this absolutely wild juxtaposition. On one hand, you've got a trailing 12-month or TTM stock return of 756.14%. That is the market heavily rewarding the stock over the past year. But then, on the other hand, you have their trailing 12-month revenue. $0 and 0 cents. This right here is the core, mind-bending paradox of our whole explainer today. The market is aggressively buying up a stock that literally brings in zero money from sales. Zero. I just really want to pause and emphasize this impossible anchor data point. For the entire last 12 months, the company has generated exactly $0 in revenue, a $9 billion valuation, and literally not a single dollar of sales came through the door.
And honestly, the fundamental reality goes even deeper than just zero revenue. Over the trailing 12 months, PRAX posted a net income of negative $303.2 million. Their free cash flow, negative $249.1 million. And the return on invested capital sits at an abysmal negative 117%. So not only is there no money coming in, but there are hundreds of millions of dollars pouring out. The mystery deepens big time here. I mean, how does a company even operate like this?
Section 2, a bulletproof balance sheet. How PRAX stays afloat. So that begs the obvious question, right? How does a company burning this much cash with zero revenue not just go bankrupt instantly?
Well, their survival metrics hold the answer. First off, their debt-to-equity ratio is exactly 0. They owe absolutely nothing in debt. Furthermore, the current ratio and quick ratio both sit at 10.22. Now, in accounting terms, a ratio of 1 means you have exactly enough cash to pay your immediate bills. So a ratio of 10.22? And this brilliantly illustrates that they are sitting on an absolute mountain of cash reserves compared to their short-term obligations.
To summarize those balance sheet clues, the company's survival is built entirely on this pristine, debt-free runway. They have zero debt and over 10 times the cash they need for any immediate liabilities. It's basically a giant financial life raft. They are burning cash, sure, but they've secured enough capital to weather the storm for a really long time without the crushing weight of interest payments dragging them under.
Section 3, the valuation paradox. Breaking the financial models. Let's see how standard Wall Street valuation metrics completely break down when we try to apply them here.
Let's start with a classic metric, the price to sales or PS ratio. By definition, this is a standard valuation metric that compares a company's total market value to its revenues. It's usually one of the very first things analysts look at to see if a stock is overvalued or undervalued based on the actual business it does. But there is one fundamental requirement for this formula to actually work.
And here is the punchline. The PES ratio for PRAX is 0. The enterprise value to sales ratio, also 0. Why? Because mathematically speaking, you cannot divide by 0 revenue. The standard formulas that Wall Street analysts have relied on for decades literally cannot process this company's current state. It straight up breaks the math.
It gets even more absurd when we look at the rest of the valuation metrics. The PE ratio, or price to earnings, is negative 23.93. The EV to EBITDA ratio is negative 25.63. Usually, investors want a positive, low PE ratio to show a good value. But here, because earnings are deeply negative, the ratios are negative too. The only traditional metric that somewhat functions is the price-to-book ratio at 9.24, meaning it trades at over 9 times the value of its physical assets. But altogether, these numbers strongly reinforce that current investors are completely 100% ignoring standard historical valuation methods.
Section 4. Making sense of PRAX. Speculation over calculation. So, how do all these seemingly contradictory clues form a cohesive picture?
The absolutely crucial takeaway is this. PRAX is valued purely on future potential. Its price is totally detached from its current profits, or, lack thereof. Investors aren't looking at the trailing 12 months of 0 revenue and getting scared away. Instead, they're looking at that massive runway of cash and betting big on what the company is building. That nearly $9 billion market cap represents an ironclad belief in a massive future payoff. The market is essentially saying, look, we don't care what you earned yesterday. We are paying for what you might invent, discover, or totally dominate tomorrow.
Which leaves us with this final, incredibly provocative thought. How long can a $9 billion valuation survive on 0 revenue? Like, as long as that pristine balance sheet holds out? Or will investor patience eventually wear thin if all that future potential doesn't eventually turn into present-day sales? It's a fascinating standoff between pure belief and hard fundamentals, and it perfectly encapsulates the wild, unpredictable nature of stock market behavior. Thank you so much for joining me on this explainer. Keep your eyes on the data and keep asking the right questions.